you have kind of a theory that the end of a bull market is when there's too many investors involved, so too many people getting into it, or when the Fed quashes it. And it doesn't look like either one of those things is the case right now.
Right. We were basically saying that a bull market doesn't end from old age. A bull market ends if the Fed puts it down or if there's over-excess, too much optimism in the system. And really none of those things exist today. In fact, 2008 through 2012, outflows from the equity market. You've seen a steady trickle back in, but nowhere near what was lost over the prior 5-year time period. So
in absolute dollar terms or in terms of percentage participation?
I'm looking, so what I was just quoting there was flows into mutual funds. But if you look at participation, we went from about a 40-60 portfolio in 08, 40% equity, 60% fixed income. Today we're about a 60-40. So there's nothing excessive in this. It's not as if many households, in the past you'd seen 65% of households own stocks. Today that's around 50%. Portfolio allocations had gotten as high as 70% equity, 30 fixed, and much more optimistic times. Today it moved from 40-60 to 60-40. A lot of that's automatic rebalancing because of the big moves in the market. In terms of fund flows, you really haven't seen those pick up in a substantial way.
I wonder about the Fed, and I know Peter has views on this, but I want to start with Priya and ask you first. It seems like we're back to square one with Janet Yellen here. I mean, for a while it seemed maybe she was going to bring interest rate increases forward, or at least a lot of other governors wanted to. Now we realize that the Fed, the whole board, is back to sort of their dovish stance that we're looking at, again, at 6 months after the end of quantitative easing, right?
Well, 6 months or more. The market's almost priced for 8-9 months at this point. But I think what was interesting in Jackson Hole is she was very non-committal. So I think she's not saying that her baseline scenario right now is for a sooner rate hike, but she's given herself an out. Because for every aspect where she talked about why she should not raise rates, she also gave, she hedged a little bit. So I think that's why you sort of see it a bit in the rates market. You see the front end moving higher in rate, which actually indicates that the market's getting a little bit concerned around that first rate hike. But the long end is on a different planet. The long end is essentially just pricing, ECB, QE, etc. But I think the front end is signaling a little bit of concern that that first rate hike might happen in the middle of next year. The market's priced for August.
I thought, by the way, on Friday, I thought if I ever have to talk about the Fed again, I'm literally going to jump off a building.
No.
But I've taken the weekend, and now I'm interested again. What do you think about that? She's right. The long end is in a different place. 3.1, 3.2% on the 30-year.
I think there's two things going on. One is I think the Fed will hike. We're actually thinking they might hike as early as March. But again, the long end doesn't have to move that much. I think they're going to hike a little bit. We're not going to get much above 1% because I think she's going to be very cautious. She's going to wait and see how it plays out. So that can move the front end up.
March would be a break exclusive.
Right.
If you went on surveillance, Tom Keene would be sounding alarms. There'd be a special red banner.
Yes.
I mean, that
but at the other
incredible.
end, I think what's starting to happen, which is actually good for all the markets, people are realizing the long end doesn't have to rise just because the front end goes up a little bit. So there's this massive short base. There's this huge short base in TLT, TBT, in real bonds. And I think that squeeze is starting to occur, and people are accepting that we probably have relatively low rates for a long time and relatively slow growth. So the long end can actually hang in, and I think we're going to get a squeeze below 3% on the long bond, and I think that will continue to be supportive of equities, particularly with the ECB.
Right, equities. Let's bring it back to where we started. Brian, what do you think? Where do you think we're headed then? Looking at S&P 2000, looking at Dow 17,000. How much longer does this go until too many retail investors get involved, or the Fed says, hang on a second, the price of bacon is going up too fast?
Well, again, I think we're in the infancy of that, particularly with regards to the retail investors. Remember, there's nothing particularly interesting about 2,000 on the S&P 500, right? That's just a nominal figure. It doesn't tell you where real highs have been. It doesn't tell you anything about earnings. It doesn't tell you anything about
valuation. It is true, but people talk. I want to say, someone said this to me the other day. It doesn't matter at all. And I said, well, it's an emotional round number that people care about. People on Twitter are talk about S&P 2000, regardless of the fact that it doesn't really mean anything.
Sure, but equities aren't a mean reverting asset class, right? Historically, over rolling monthly 1-year period, stocks are up 75% of the time. Over rolling monthly 15-year period, stocks are up 99.7% of the time. So this is not a mean reverting asset category. So again, we're in the early infancy with regards to equity investors coming back in. For a variety of reasons, improving global macro conditions, I think accommodative monetary policy well in the future, favorable demographics in the United States, which I think is a misunderstood point.
That's very misunderstood. I mean, everyone thinks that we only have 60, 70, and 80-year-olds in this country.
So the most common age right now in this country is 23 years old. the median age is 37 years old. That means the median American is more like Peyton Manning than actually watch Peyton Place on television, right? We have more 20-year-olds than 30-year-olds, more 30-year-olds than 40-year-olds, and our 50-year-olds, our average baby boomers, are people like Eddie Van Halen. Our youngest baby boomers are people like Eddie Vedder. This is not the face of a graying population. This is the best demographics we've had since the early 1980s, the last time the U.S. set forth on a longer-term secular bull market.
Priya, if that's the case, if there's so many young kids out there, and I would trade my entire portfolio to be 23 again, why are rates so low? I mean, why are people so concerned that they seek the safe haven of bonds?
Right. I think there's a disconnect here. I think the market believes that there are a lot of people that are about to retire. If you look at bond inflows, they've been significant. But I think what people miss is that all these flows follow returns. Returns for the bond market have been great this year. So this money is all going into bond funds. I think it's sort of misplaced. I think there's a lot of pessimism about the economy's ability to handle higher interest rates. The market, we estimate, is only pricing in 2.5% as the end point of the Fed hiking cycle. Note that the Fed themselves think that that'll be 3.75, which is historically low. But the market's pricing in even lower than that. So I think while the equity market might be pricing in this optimistic long-term view, the bond market is not. And so if we do see a couple of quarters of 3% growth, the Fed says, well, we're going all the way up to 3.75 or 4%. I think the long end of the market is mispriced, of the rate market, that is.
All right, so people should look to TBT or maybe a shorter.
I would look to shorter
duration.
I prefer still the bond side, and I think for the equities we have to start looking to Europe again, because ultimately if the QE is going to happen there, that's interesting. As the dollar appreciation starts going through, we're going to start hearing noise about the impact on the FX translations for earnings. So I would look a little bit more to Europe here. If the QE is really going to happen, Draghi's going to be creative, I think that's probably the next wave of upside.